Well, good afternoon to everybody. This is Mike Murphy with CattleFacts, and we just want to welcome you to the CattleFacts Trends Plus webinar here this afternoon on the 31st of August. We appreciate you taking time out of your schedule to be with us and look at some information as it relates to the market and really looking up the cow-calf sector in terms of their opportunities and what they should be looking for as we look forward here into the next few years of this cattle cycle. There are several numbers here on this first slide that allow you to call in and use that PIN number to connect so you can hear us. And hopefully at this point in time that you can hear us. If there are challenges for any of you unable to hear us, then please let us know in that little chat area as you look at the screen in the lower left-hand corner. We will also be recording this presentation for those that are unable to be with us here this afternoon, and we'll be sending out that link to that recording sometime here tomorrow. So as we look at the information that we're going to talk through here today, we're going to talk through the cattle and feedstuff market projections from now into 2017 and really tie in some of the concepts of where we are from a cyclical perspective as we look at production levels, looking a little bit deeper, even into 2018. We'll also look at just that bigger picture perspective for the cow-calf industry. We've talked some in here in the course of the last couple of webinars in 2016, just where we are cyclically and what we should expect, and we want to give everybody an update on those meetings as well. So we're going to go ahead and get started, but as we start to talk through the information, the first thing we want to do is thank Elanco. Elanco is the sponsor of the Trends Plus webinar, and you will hear Dr. Bruce Hoffman a little bit later on in the webinar talking about some things relative to weaning calves. But we really appreciate the sponsorship from Elanco. We've very much appreciated them being a primary sponsor of this Trends Plus webinar over the course of the last couple of years, and they've been a great partner of CattleFacts for many, many years, and so we appreciate all the support that they provide to us. So as we start the discussion, just looking at things relative to where we are from a drought perspective, you stand back and you look at this drought monitor map that was actually issued here just in the last week, and you continue to see that western part of the United States that has still a sustained drought challenge. Especially in the region of California, but all of those really western states have continued to be plagued with dry conditions. As you move closer back to the east towards the Continental Divide, things improve. Not as much as maybe some would like, but there has been some improvement compared to where we would have been a few years ago. Looking at some of the region in here into that northern plains area, there are a few dry pockets right around that western South Dakota, northeast Wyoming, and parts of that southwestern Montana. But for the most part, the remainder of the central plains, going all the way into the Midwest and even covering most of the southeast, we are in a very, very good position coming out of the summer in terms of this drought condition. So we feel like that from Mother Nature's vision and her perspective, we are set up to continue to have a very solid base as we start to think about forage, not only from a cow-calf perspective, but also looking at it when we think about the feed yards standpoint as well. And that really leads us into our first discussion, as we just want to give us all a big overview of where we are in terms of the grain market and the hay market. As we start with the corn market, we've had a great season this summer in terms of corn production. And that certainly was shared with us when we look at the WASDE report earlier in the month of August that stated that we have projections of a 175 yield for corn yield this year. Obviously, that's the best production that we'll have from a historical standpoint. We also are dealing with excess supplies of wheat and, in many instances, even other feedstuffs like milo. So overall, as we look at the Midwest Central Plains area, we're flush with grain. And the net of that, as we start to think about the value of corn as it relates back to the value of feeder cattle and calves, and we'll talk about those more in depth later on, we should be in a very comfortable environment over the course of the next 6 to 9 months as you look at this chart, where a lot of the period of that time will be corn trading between $3.15 and $3.65 for a practical range basis the spot corn futures. Now, those that might be listening that are actually in the corn production business, obviously you'll have to account for your local basis as to what that might mean for your cash prices. But this should be a very comfortable level, and really the foundation of that is that we're dealing with a stocks-to-use level that will be on top of 15% as we look in here over the next several months, and the current projection is 16.6% from the USDA. As we connect that dot back to what it looks like in terms of hay values, your grass hay, if you will, we're going to spend a lot of time in here, right around $100 to $125 on what we define as a U.S. average. You're still keeping a fairly lofty premium to the alfalfa market, and most of that is associated because of what's going on in the western United States. Just still no forage being really produced out there, and so as we look at prices, that's keeping really all of the U.S. somewhat elevated. But in both categories, we should be dealing with a very manageable hay cost as we look at those from the end user standpoint in the course of the next several months, really the next 12 months as we think about it from a hay cost perspective. So thinking about what that means to us, and as we start the discussion from the cattle and our overall inventory of the cattle herd, this first slide is just looking at the beef cow inventory. We have obviously seen continued expansion as we think about the number of cows we had on January 1 of 2016, and that expectation is to continue to grow in the course of the next 2 years. The key with this number is that will result in more cattle to be harvested in the course of the next couple of years. And ultimately, as we think about that relationship, bigger beef production. That's the bottom line as we look at things, is there's going to be bigger beef production, not only here in 2016, but as we look in here towards 2017 and 2018. And the importance of this is just what the market's going to continue to have to be dialed in as we look forward here in the course of the next couple of years. And not only is it bigger beef production, but we're also going to be dealing with bigger production from our two competitors, pork and poultry. Now, the long-term trend, we all understand that we are in a long-term uptrend as we look at total protein production. We level off coming through or out of the recession period. Obviously, had a couple of outside influences when we think about the pet virus and to a lesser degree the bird flu environment. But now we're back on to seeing that significant growth in terms of that total production. Beef pork and poultry. And that will continue to be the situation as we look at 2016. Just shy of 96 billion pounds. And by the time we get into 2018, this domestic production will be at 100 billion pounds. Now, please keep in mind this is domestic production, but what this is telling us is it's putting so much importance on the fact that we have to be able to export this protein. Export it to one of our key trade partners around the globe. The challenge that we've run into relative to this situation is that our total exports as a percent of production, when we look at beef, pork, and poultry, we've lost ground in the course of the last couple of years. When we look at it, 2014 and 13, we were sitting in there at about 17%. We gave that up in 2015, and even again here in 2016, we're still have given up the ability, if you will, of exporting a higher percentage of our total protein production, which for the most part, going back since 1990, has been a long-term trend. Now, you all recognize that those blips of 2004, 5, and 6 was clearly related to the fact that BSE limited our ability to export beef. But overall, this has been a long-term trend that now has started to be tested, potentially violated, if you will. And that's a concern as we start to look at the market. Now, there's really a couple of key components that we can address with this decline. Number one, in the fall of 2014 is when Russia banned our pork and broiler meats. They quit importing from the U.S., and that has had a direct influence on our ability to export. We have not been able to find another trade partner to the same level that we had with Russia. Also, as we've come through here, more so in 2016, the record large imports of pork that China has incurred, the U.S. has not maintained its market share in relationship to 2014 and 15. Those are two of the most key factors that have influencing our ability to see this long-term trend of exports as a percent of production continue to grow. This becomes very much of a sticking point as we start to look at the market. And as we have that evaluation, the first thing we want to talk about is within our sector of the beef supply, what that looks like when we start looking at per capita net beef supplies. We are going to see an increase here, and we have seen an increase here in 2016. It will likely amount to about a full pound. It may end up being a little bit more. And then as you look in here, by the time we get to 2018, we're going to see roughly another 2-pound increase. Now, that does have dialed in increasing exports of beef during this next 2 to 2.5 year period. But we're still going to see that overall increase in that total per capita net beef supply. Taking and combining what we find in terms of total proteins, or in this example, beef, pork, and poultry, we've shared with you at the beginning of the year, and really even last year with the webinars, the shell shock that we incurred with that big increase in that supply of basically 9 pounds in 1 year when you went from 2014 to 2015. We've got roughly another 3.5 pound increase this year, and then there's still another couple of pound increase going in here in the course of the next couple of years. What this has created is a challenge for the production systems of cattle, hogs, and chicken. And that inability to get this excess supply off of our domestic market at the same rate that we had experienced coming through the previous 2+ decades has created an environment where we have seen these production systems lose leverage to the domestic buyer here in the States, and the best measurement of that is looking at the live value for each of these 3 proteins as a percent of their retail prices. And as you look at that chart, somewhere in the last 9 months, each of these 3 proteins, as you look at this relationship, the live value as a percent of that retail value is sitting in here at essentially at or near a 10-year low. That's what the data is telling us as we look at this. And we believe that this is in part being created by the fact that we don't have a robust enough global marketplace for our proteins. It's not to suggest that that exports are declining in terms of that total volume. They're just not increasing at the same rates relative to what our production increases have done. And that's created that leverage, as a term that we have used a lot internally and within a lot of our publications, that leverage that's gone back and has favored those above us. Well, what has to happen to this process as we start to kind of dial this back into the influence back onto the cattle market? And there should be some seasonality to this leverage. And part of that seasonality should be that we should gain a higher percentage of the retail price into the end of the year. That's a very strong seasonal pattern to the market. The question becomes, as we start to look at retail prices, and we've got all of the proteins on here, and we've included both choice beef and the all-fresh beef values. But will these retail prices come down relative to our competitors? As we start to see bigger increases in production, which we will in the beef sector, and we will see even a bigger increase in that per capita net beef supply, what will it take for us to be able to move that product or that excess product to the system? Will it take lower prices to incentivize that retail consumer? And as you look at this chart, you can already see relative to the last 10 years, we're widening the gap between beef and our competitors. Now, to be fair, we are a steak and hamburger society. Chicken is a wing and breast society as we think about what the consumer takes on. Pork really is a little bit more diverse, as they have obviously bacon, some degree to the ham, and then the loin, if you will. But our price spreads have widened, and that could be a little bit of a challenge for us as we start to think about the marketplace. And as we start to evaluate the decline that this market has incurred, I'm going to go back to and just refresh our memory of what this supply looked like in 2014 and 15 on a per capita basis for beef. And then what's this look like relative to, really it was a 2014 window when you looked at all of the proteins. But now where are we as we start to grow these supplies, thinking about price? This is the CattleFX fed steer price going back in the course of the last 10 years. The cycle highs of 2014 were established when we look at fed cattle on top of 170. We're nearly in a period here where it's been a sustained downtrend for 2 years straight. We had a little flurry of a rally from December of last year into March of this year, but for the most part, this has been a downward trending pattern for 2 years. As we step back and look at where we were in that 2006 to 2011 environment from a price standpoint, looking at fed cattle, and then start to connect the dots when you start thinking about that total supply environment. We were going through a period there where total protein supplies were going down. You look at the beef sector, same thing. Total beef supplies were also going down. And we're not anywhere near to the recovery of these supplies, at least on the beef sector, like we were in this area here. We have projections to come back towards those levels and actually exceed most of that window on the total protein standpoint. So the question becomes, where will this market take us to? We look at this long-term support, and you've seen this before, from the periods as we go back and we look at the market, from 1996 as we established fed cattle lows in the mid-50s, really through 2002, we were in a trading range of the market that was, basically the mid-50s to the low 80s. And then we transitioned coming out of 2003 after we got past the destruction from BSE, that when we traded into a new trading range of a practical range of, call it 80 to $1. And then we transitioned again in 2011, where we moved into a new range and obviously moved right on up into our cycle highs. The question becomes, what can demand sustain? We know supplies are growing in the course of the next couple of years. 17 is going to be bigger than 16. 18, supply is going to be bigger than 17. The question is, as we start to look at the value of fed cattle, what will demand sustain? And demand encompasses the relationship of leverage between cattle feeder and packer, processor, and retailer, or end user consumer, however you want to define that. And that really lies the challenge as we look at things relative to the market. What can we sustain as we look in here going forward? So as we dial this in, and I'm sure many of you are wanting to look at a more narrow window of what this market's going to look like in the course of the next 6 to 9 months. And the relationship is, we believe as we look at the market in here, there is excellent support to this market defined somewhere in the futures are already trading this, is why we bring this to our attention, somewhere in this area between $1 and $1.10. Excellent support for this market as we look at that level in the course of the next 6 to 9 months going into next spring. The top side of this market, though, is probably also got stiff resistance in here in what we would define as the 120 to 125 area. Now, that 20% to 25% range is a fairly wide range in the marketplace. It probably will look to be a little bit more narrow than that when it's all said and done with. But this is where we would define the range of the market. And with what we know today, we would expect to be a fairly seasonal type of a pattern. We'll get some recovery coming out of this late summer window into the fall. We'll pull back the market into the winter, and we'll have one more push back there into the spring time frame. The concerns that we have is that will we find any relief to the leverage component for beef or cattle that would favor us? And if that answer ends up being no, then we're probably going to have to spend more time in the bottom two-thirds of that projected range that I just laid out than the top two-thirds. Now, as we relate this back to feeder cattle values, this relationship in here as we broke out there in 2011, now keep in mind we were dealing with a different sort of corn environment at that period. We should find really good support to the feeder cattle market in that low to mid-30s between now and next spring as we look at the marketplace. again, I bring that to our attention because that is, in fact, where the feeder cattle futures have been trading, actually a little bit lower than that level. But on the top side, because of the equity drain that the cattle feeding industry has incurred, which has been 18 months of consecutive losses for the feeding sector, we're going to have a hard time spending any time really back above the upper 40s during this period. It will be very challenging, and there's two reasons that the risk is it will spend more time in, say, the mid-30s, and that would be as if corn went back up towards the high end of the range that I projected. But this will likely be the projected range for feeder cattle as we look forward. From a calf standpoint, there's a little bit better news from their perspective, and these are the key reasons why. Number one, you've got more outlets. Again, going back to the drought map, we've got a very solid start to winter grazing in the Central Plains. We've got a lot of forage around for backgrounding operations, and we've still obviously got some demand from the feed yard standpoint. So they're going to find where their market is got more buyers at least. That being said, you're still going to be looking at values that are probably going to spend a lot of time for a U.S. cattle facts fed steer price in the low 140s into the low 150s. And if we're looking at a Central Plains equivalent, you're going to be $5, $6, $7 above that from an average standpoint. What the cow-calf operation needs to understand, and as you guys will listen to Ethan going here in a couple of minutes, where we are in the cycle. As we've talked in here, the cattle cycle was really on sabbatical as we think about where we were from the mid-1990s up until 2014 to 15. The market was very forgiving. Values on average went up every year. But as I shared that bigger picture supply situation with you to help you understand that the cycle has turned over, there's price risk in front of us. If demand doesn't become a super challenge, then really from a bigger picture standpoint, we won't take values much lower than, say, $1.25 in here over the course of the next few years, which will put some operations, as Ethan will talk about, probably into some red ink. But for where we are today, the corrections won't be as severe. But so much of that's going to be dependent upon what we can do with beef demand and then the relationship as it relates back to our competitors on pork and poultry. Will we be able to get an upper hand in that protein sector? So with that, I will turn it over to Ethan Obrist and let him continue on with the webinar. I appreciate your time. Thank you.
Thank you, Mike. Hopefully all you can hear me. I just want to thank you for being with us here this afternoon. As Mike alluded to, we will get into a little bit more of the cattle cycle, how cow costs play into that, obviously kind of a little bit of a longer term weather outlook as well. So not wasting any more of your time, we'll just get started right in it. Obviously, this slide is not a surprise to anybody. Obviously, we do not have 2016, the entire year as percent of normal yet, but what we can see is obviously 2015 was a major year for cow-calf producers, and obviously what they call the beef belt right through the Central Plains here. That's obviously seen, upwards of 200% more precipitation than normal. That's kind of what created this. We are still in expansion. In January 1st, 2017 report, we will see an increase in the cow herd number once again. We are actually predicting an increase in the cow herd number in 2018 as well. You start to look at some of the numbers, start to look at some of that behind that from a weather standpoint, from a profitability standpoint. We have started expansion, and it's pretty hard to slow down once you start. So we will continue to expand. A little bit more of a shorter term outlook here. This is March 1st through May 1st or I should say May 31st of 2016. Same areas through the beef belt here. We do see that that is up to words of 200 to 300% more than typical precipitation. And as it goes, if you get your rain in the spring of the year before that grass matures, your summer's met. Obviously, getting some of that fall rains can help you, stretch out that forage crop until the fall as well. But for most of the country, or I should say most of the beef belt here, we have gotten adequate rains through the spring of the year when it really matters. So what does this all matter? Obviously, we know we've gotten great weather. We've gotten good precipitation here so far in 2016. So in a recent cow-calf survey, as many of you have probably seen in our publications, we have referenced it. Hopefully, many of you took that. We do appreciate that. We asked one question: what was the main reason for recent expansion? And kind of behind that as well, we're kind of trying to find out what drives producers to expand. And one of those questions, obviously, what was the main reason? We had the additional forage and additional grazing. Additional forage was more from the standpoint of additional precipitation compared to what we saw in 2014 and prior to that. Additional grazing obtained. Obviously, with more grass, more grazing becomes available through leases, through purchases. Obviously, that becomes more available. So with that, the total forage, was a 34% answer. 34% of people that expanded answered with the question of that was one of the main reasons why for expansion. Profitability has been there, as Mike alluded to. We've had a fairly bullish run here for a long time in the calf values, and so the profitability has been there. We'll get to a slide later on here that kind of shows some of our long-term cow-calf returns, and profitability has been there. We just had to have relief from Mother Nature in order to expand. So that is one of the main driving factors. And going forward, as some of that profitability still remains, as we get additional rains, as we get additional precipitation, the economic drivers behind it, or I should say there in Mother Nature, will allow us to continue to expand and give the incentive to continue to expand. Given a little bit longer term look, this is from Dr. Art Douglas that we deal with we've dealt with for 30 plus years now, I believe, well before my time, but this is his long-term outlook. He gave this at the beginning of this year. Obviously, there's been a lot of rumors surrounding the weather factor. But this is kind of the percent normal, compared from November through April, so through the winter. And as you can see, all these blue areas, large majority of where the cattle reside in the U.S., they're still going to be very, very well off going forward. As one of our older members here at CattleFacts referenced this to me here a couple of days ago, it's kind of like back in the 70s. I wasn't around then, but as you can see, we're moving into more of a wetter period than normal. Through the summer, obviously, we get a little bit more relief up here in the Northwest. Kind of back to a normal or long-term average precipitation levels, and obviously on a whole, though, it is, there are some more wetter pockets there that we can see throughout the country. That doesn't mean that we won't have dry years as we go through this wetter than average period, but at the same time, it means that more often than not, then we'll get a summer and a winter that has more precipitation and allows us to continue to use those cheap feed sources, those cheap forages that cow-calf operators have done so well on going back generations and centuries. Kind of moving on, so to give the other answer to that question, what was the main reason for expansion? Profitability obviously was a huge factor in that. As you can see, 37% of the respondents answered with that this was the main reason. Obviously, with the profits that we had in 2013, 2014, especially 2014 and in 2015, obviously there's that incentive to go out there and get as many cows as you could around you in order to take advantage of that. And obviously the projected profitability going forward, no one quite saw magnitudes of corrections that we saw in the second half of 2015 so far in 2016. So a lot of that obviously was playing into it as well. As we've alluded to, the cow calf and obviously the beef industry in general is not an industry that can just turn on and off the switch. Not like pork or poultry, where we have they have much shorter production phases. The cow-calf industry obviously has a longer production phase. When you're looking at from when that cow was bred to the time she has a heifer calf and that's bred again, you're looking at several years. So that production phase is quite long. So what does this mean from a profitability standpoint? Obviously, the best tests here so far for about 80% of operations are, summer, or I should say spring calving, fall weaning operations. And the best tests we've had on that market so far have been these summer video sales. They've been pretty consistent. There's been one or two sales that have been stronger and weaker, but they've been pretty consistent. For a 550-pound steer, you're looking at about $155 a hundredweight for a 550-pound steer. 500-pound heifer, you're looking at about 15 back. 10 to 20 back was probably the full range, but I just gave an average. So what does that give an average revenue per cow? You're about $775 per head. If you, that's given that you have a very good calf crop and you sell all the heifers. Obviously, I know that's not the case for every operation, but I just kind of wanted to establish a base. Obviously, going forward, we can kind of see the trend here. It has followed the seasonal pattern a little bit. We did not have quite the spring run that you usually anticipate in the calf market. That was a lot to do with the uncertainty of the back end of the futures in feeder cattle markets. There was just not a lot of promise out there. Really been here for a couple of years. Have been very pessimistic in the deferred live cattle and deferred feeder cattle contracts. So that has definitely created a little bit of this lackluster spring rally that we saw. And obviously calf values, they get cheaper through the summer. As we get out in here into the fall, where we usually put in our seasonal low, I do think we will see some cheaper calf values come out there. We have drawing from a larger cow herd, more calves. There's been, from what I've been able to tell, is there has been some quite a few PO'd calves off of the summer video sales. So we will have quite a large fall calf run. It looks to be like. So we do believe that calf values will put in their seasonal low out there in October, November, closer to probably that 140 level, than as we alluded to, or as Mike alluded to here recently. So going forward here, in that same cow-calf survey, we asked what cash cow costs were. The low return producer, obviously, if we use a base calf price that I alluded to of about $775 for a steer, about $700, or I should say $850 for a steer, $700 for a heifer, gives an average about $775 per cow. As you can see, the low return producer, he's definitely in that area where he's starting to feel a little bit of a pinch. And I know that's obviously, there's many operations that have heavier weaning weights, better genetics, premiums for weaning, premiums for whatever it may be, natural, something along those lines that can kind of shore up, and adjust for those cow costs. But we do feel like the top third, or at least a portion of cow-calf producers are feeling the pinch from a cash cow standpoint with where calf values are. In turn, that will slow down expansion. I don't think it's enough to stop it, but it will start to slow it down. As you can see, our average return producer with the $650 cash cow cost in 2016, and given the values that I mentioned above, we're still in the profitability standpoint. We're looking at $100 to $125 a head for some of those cows, and that's historically that's very good. You look back here, and you can see here there's not many years where we're above $100 a head. Obviously, this has a great variability in it. Every operation is different, and that's one of the beauties of cow-calf operations and cow-calf business in general is there's so much variation between operation. As you can see, is we're going to have to take the calf values quite a bit lower in order to get all the producers where they start to feel the pinch. And you know, as Mike alluded to, we do see some weaker calf values out in front of us. Probably a little bit more support there than some other markets. But you know, with the variability and options that we have with those calves. So you know, as we look at it, take a little bit more money out of this calf market in the next couple of years, and we'll incrementally slow down expansion. Just kind of want to hit on this. Obviously, total cash or total cow cost includes depreciation and return to management. That's not how we calculate it in the survey, but that is another factor. I added about $125 a head for that. Obviously, that's going to be, you know, vary depending on how much you pay yourself, how much you value yourself, and obviously what your depreciation is on your equipment and your cattle as well. So just kind of wanted to highlight that. You know, if producers are calculating out that, then that signals a little bit more, or a few more producers are actually feeling that pinch from a cow cost standpoint and where the calf market is. Obviously, this is a chart that Mike just used. I did kind of. It's very important to go through this. But you know, obviously, you can see that the cattle market is cyclical. Obviously, we've heard a lot of rumors that the cattle cycle has been broken here in the last 5, 6, 7 years. I'm not a proponent of that. I think obviously the circumstances that we saw with the drought, especially in the South, and then the perfect storm for the pork and poultry industries there in 2014 really set us up to kind of extend that rally or that peak or that cycle high in 2014. I still think that the cattle cycle will you know, get back to its old ways of seeing these peaks and values about every you know, 7 to 10 years. Obviously, you can see this a little bit longer term graph, not from a price standpoint, but from a total cattle inventory. You can see how cyclical this market was and how we've done this before. And obviously, this includes dairy cattle. Really, here in the last you know, 30, 40, 50 years, they've been basically flat. But they definitely did contribute to some of this, you know, up here and you know, this peak up here. But you can see how cyclical that cattle cycle has been, and how much it got drawn out here. A lot of that obviously, you know, was through drought here in the early 2010s, you know, especially in the South. Moving on here, obviously this is what the calf price breaks from the cycle highs. You can see those cycle highs that we you know, highlighted here above. Obviously the 79 cycle high, it took a very, very long time for us to put those lows in. You can see how far we are out here. It did drag out here, you know, up to several years, and you can see the magnitude of 2014. Obviously has not reached the magnitude of the 91 break that we see here. But we have reduced, you know, calf prices from about 45% from the cycle highs there in the peak of 2014. So what does this mean going forward? I'm on the proponent that we're not going to see this magnitude of a break that we saw in 2015, 2016. But I do think we have to get out here a little bit further before we can say the cycle lows are in. I do think that the cycle lows are a few years out in front of us. I think the year-over-year breaks that we have seen in 2015, 2016 are behind us. The price breaks will be much narrower, but I do think there is some year-over-year declines, albeit, you know, much smaller. So what does this mean from a cycle standpoint, from a cow herd standpoint? You know, we're starting to see some of the data. You know, obviously we really need to see the fourth quarter. You know, where this data is going to line up as a heifers as a percentage of fed slaughter. This will tell us how aggressive we were with our calf market in 2015, or I should say our calf crop in 2015, and then going forward. If we start to see this number, you know, start to increase, which some of the placement data would suggest so far through the summer that we will start to see this number increase. Probably not back up to, you know, non-expansion year levels, but at somewhere in between this 2015 number and other expansion or heifer expansion years. So some of these factors are starting to come into play of exactly, you know, we're starting to slow down expansion. We are not in a liquidation phase yet. We will see a larger cow herd for January 1st, 2017 USDA report anticipated right now. that we will see a larger cow herd, or maybe even a steady cow herd on the January 1st, 2018 USDA inventory report. Looking at the beef cow culling rate, this is basically a number of, we use the total beef cow herd on an inventory from the January 1st inventory report, and then compare that back to what beef cow slaughter did that year. And as you can see, all these green years, when we're down here below this 9% area, that is when we've tried to expand on the beef cow herd side, and you can see that in 2016 with our beef cow your beef cow slaughter numbers. We are still in an expansion phase. With our estimates for 2017, we're up about 200 to 300,000 head on our beef cow slaughter in 2017. Right around that 250,000 mark is where we estimate where we'll be, up above 2016 year ago levels. But still, with that being said, that's still only about 9% of our anticipated beef cow herd on January 1st of 2017. So we're not back up to these liquidation levels quite yet, but we will see those levels here in another several years. And you can see the cattle cycle or the kind of beef cow expansion cycle here as we go, and anticipated that we will start to see that climb back up. Just obviously illustrating that here, we will start to see beef cow slaughter increase, and obviously that's our 2017 forecast. So with that being said, I've been getting a lot of questions recently, as CattleFax has as well. When do we start to slow down expansion? When do we start to see a liquidation? And I think we have to be patient in that. The incentives through 2016, albeit much smaller than they were in 2015 and 2014, the incentives, both from economic and Mother Nature precipitation standpoint, forage standpoint, they are still there. We still have majority of the cow-calf industry profitable, and majority of the cow-calf industry has plenty of forage to use. So the incentives are still there to expand. Obviously we are going to start slowing it down. Without a $500-600 a head profit on our steer calves, heifer calves, like we saw in 2014, 2015, it's much less of an incentive to expand. But as we sit right now, we do look to increase the cow herd over the next couple of years. So we need to be patient in that. As long as we're expanding the cow herd, we will see supplies through the feeder cattle level, through the fed cattle level, and obviously that increase in beef production, as Mike alluded to earlier, will increase at several years down the road. With that being said, I'd like to introduce Dr. Bruce Hoffman. He is the Director of Cattle Vaccines with Elanco Animal Health. Hopefully he's audio works for him. And with that being said, it looks like he just jumped on. So I will turn it over to you, Dr. Hoffman.
Thanks, Ethan. Appreciate you and Mike sharing that important information with us. Obviously, my passion as a veterinarian is how can we continue to keep calves healthy? Vaccination has been shown to not only protect the health of the home herd, but also through proper vaccination, we can add value to those calves. As we go into this fall, one of the key things is optimizing value of those calves. And so with that, I'd like to just do a couple key things, highlight areas as we talking about getting that weaned calf off to a good start. And I think the key on that is we got to remember some real basics of immunology. And remember that when we vaccinate, we don't necessarily immunize or protect that calf, okay? That's the vaccination of actually giving that shot. It's the animal then to actually create immunity from that shot, okay? So the animal then produces protection for disease that we vaccinate for. Remember that not all animals react the same way to a vaccine. We want to make sure that these animals, ideally the majority of animals react very positively, have a good immune response. Some things that we want to do to make sure that that protection is assigned to each one of those calves is, stress on calves is huge. Obviously, the weather patterns that we're looking at looks good, And but when we handle calves this fall, whether we're preconditioning, whether we're weaning those calves and working those calves, we want to make sure that we handle them calmly, quietly, because stress will decrease the effectiveness of that vaccine. The other thing we got to remember that ideally, hopefully, everybody listening has done some vaccinations at branding or at spring working. And so, as we get into fall, we can give this next round of vaccines, and remember that that boosts the first one, and obviously it helps protect that animal quicker if we've had a previous vaccination. Sometimes I think we forget that the day we give that shot is not always immediate protection. So we'd like to give it shot before animals are exposed to high levels of stress or disease pressure. The other thing is remember that vaccination will induce the incidence of disease, the severity and duration. We can, in the face of vaccination, especially with respiratory disease, we can still see some calves experiencing respiratory disease, and that's why it's important to continue to monitor your calves and make sure that there may be a calf too that does need treatment, but in general, the group of animals, we want highest protection that we can. The other thing, occasionally we'll get calls as far as, are there swelling at the injection site? Now remember, one thing is we do see some mild swelling at the injection site on some vaccines, and remember that when we give a vaccine, we are actually causing a reaction there at the site, and that stimulates the immune system to build that protection or build that immune response to that vaccine. I'd just like to go over a couple products that Elanco has to offer. They're pretty unique, and the first one is a titanium 5 PHM, and this is a convenient combination vaccination that is used primarily in the fall preconditioning and or weaning, where we have the convenience of both the major viruses and the Mannheimia and Pasteurella in a combination shot. The nice thing about this product is that, as we can see here, vaccination, our study results show that titanium 5 did not have a negative effect on feed intake. So as you wean those calves, the last thing you want to do is give a vaccination that would have a negative effect. Actually, we want to get them off started right. We want to get the feed so they're eating well, okay? And so that's why our studies show we have not decreased feed intake. It is a modified live component. We have, when we mix the modified live with the bacterial component of the Mannheimia and the Multacida, we've shown that there's no interference. So producers, you can expect to see a good level of immune response and therefore protection from both components, even though these vaccines are mixed together. We have several operations that want to just give a Mannheimia vaccine added to their current. We have a product called Nuplura, and this is actually the highest tech vaccine. In fact, that it's a DNA recombinant, so that we are actually controlling the level of glucotoxoid in this vaccine. So we definitely have a safe, effective, controlled vaccine for Mannheimia hemolytica, which is the #1 bacteria isolated from pneumonic lungs. VirusShield is a product that is used throughout the entire United States. This is an inactivated product that is very flexible. In fact, that we can use it into any whole herd protocol, whether we're using it on our cows, whether we're using it on our calves, but we do not have anything that we have to, no restrictions that we have to require cows to be vaccinated prior to breeding. We can vaccinate calves on unknown status cows. So it's safe for the entire herd. So this is a product that continues to be used throughout the West, throughout the United States, as far as an effective vaccination for the key viral diseases. Intranasal product, Quick Shield, contains both IBR and PI3. We know that this product we can go either intranasal, or this product is unique in that we can also give it sub-Q for producers that would rather give that sub-Q or intranasal. This product offers IBR protection and parainfluenza 3 protection with both of those. I think the key is, as we look at vaccination in general, I think the issue is work with your veterinarian. Elanco is committed to working with veterinarians, and ask your veterinarians as far as how can I best set up my cow herd with proper vaccinations so that I could do two things. Number one, I want to make sure that calves stay healthy. And ideally that is when they're on your ranch or your farm, but also as they leave your operation, we want those calves to stay healthy. We understand the pressure of antibiotics, the pressure of treatment, and vaccination is one thing that can assist in keeping that animal healthy when it's exposed to other cattle, other potential organisms out there as it moves to the ranch. Number two is we know that, especially in the pressure on the calves this fall and some of the price issues that Mike and Ethan talked about, that we want to do everything we can to market our calves at the top of that market, and making sure those calves are properly vaccinated is a key component of hitting the top price. We just want to thank Cattle Facts for the opportunity to work together on this. All of us want to provide good information, and I just thanks for the opportunity, Mike, Ethan, to be working with you today.
Thank you, Dr. Hoffman. We appreciate the sponsorship and all the support that Elanco has provided to us over time, and in particular the Trends Plus webinar. We do have just a couple minutes for a couple of questions, and one of the questions is that will cheaper feed push more heifers to feedlot slaughter versus retention? And really, I don't think that'll be the case because of what we've just come through in terms of the equity drain at the feedlot sector. And that decision is actually made more so at the ranch level. And I think with actually the cheaper feedstuffs, it'll help some of those cost structures that Ethan talked about, and maybe lowering those a little bit and improving that bottom line, if you will. Another question is that, thinking about just the value as we look to manage risk in the marketplace, and specifically the feeder cattle, there's a lot of premium to be paid for utilizing the option market. And unfortunately, there's not much we can do to get around that in this current environment that we're at. The market continues to have big swings. Yesterday, from the low to high, October feeder cattle futures had a $6 a hundredweight move. Fed cattle values dropped $5 a hundredweight this week in 1 week compared to the week prior, from 115 to 110. And that's the kind of stuff that creates those higher premiums in the feeder cattle marketplace and the live cattle marketplace when you look at option values. So until we can subside some of that volatility, both in the cash and futures market, we're not going to be able to do much from that standpoint. And then, kind of a predicated cost of gain for this year's calf crop. As we look at things, and cost of gains are going to be really running in the mid-60s in the north, and into the low 70s, and that's not with a lot of weather influence, if you will, as we look at things. And then a final question as we wrap things up is, relative to the political environment that we're dealing with, and how will some of the issues as it relates to our export markets be influenced by our environment as we move into a new presidency here into next year. And I think quite honestly, as we step back and look at it, I think most of us understand that China is really the driving force of our export growth from the beef sector. And there are several challenges today that aren't really politically connected at this point as to limiting our ability to get China open. So I think that whenever the new administration gets into place and they get their staffing into place, then obviously our trade organizations, the Meat Export Federation and NCBA, can certainly start to reach out to those groups to see if we can't start to kind of push the envelope here on getting access to China for beef. There's other questions that you may have. Our email addresses for both myself and Ethan are up on the screen today or at this point. So please go ahead and jot those down and drop us an email. We will respond to you. As I said earlier, we will get the recorded version of the webinar out tomorrow. We do have a couple of other new sessions coming in. We've got an Outlook and Strategy seminar on the 29th of November that we'd love to have you participate in. And then our next Trends Plus webinar is scheduled for January 25th. As we shut things down and we stop this webinar, again, we want to thank Elanco for their sponsorship. When we turn it off, there will be a thank you screen that comes up, and then immediately after that, you'll have access to fill out a survey. And those surveys really do us a lot of good in terms of improving these webinars. So please take the time to fill out that survey. And again, thanks Elanco for the sponsorship. We appreciate all of your time. And if you have other questions, please email either myself or Ethan. Have a good evening. Thank you.